Hi, Greg Weldon here with another episode of Money, Markets, and New Age Investing. Somber times. We're here now, coming up to this weekend in preparation for what's going on in the Middle East, but really trying to maintain focus on what all of this might mean for the markets. And within that context, we go straight to the data. We have very interesting data in the last 24 hours coming from China on Friday. The inflation rate at 0. 5 straight months of no inflation in China. Now they have a policy rate that's at 3.45 that has only been brought down by 20 basis points since last year, which leaves them at a punitively restrictive real policy rate of 3.45. The 3.45 rate relative to the 0% inflation rate. That's up from 1% last year and hasn't been negative since 2020. So this is a kind of one of the knocks on China is they haven't been more proactive in stimulating the economy. Okay, you've gone through this, COVID lockdowns. Now you're going through this, decline that we're seeing that I'm about to give you the details on in terms of trade and in terms of the final demand in China itself. And I have to stop and ask myself, is this somehow on purpose? I mean, are they squelching final demand in the place that has been the engine of final demand growth in the global economy for the last decade? Is it possible to weaken the West? You kind of know my view on all of this. We're in an economic war, and the Chinese have pulled some brilliant moves from their perspective. They played this extremely well, and to think that this can't be part of it would really be short-sighted, I think. What's the transmission thereof of this kind of, slower to ease, not really being stimulative monetary policy? And what's the transmission throughout the world? Well, of course, it's in trade. The largest importer of goods, the largest exporter of goods every single month, more than 300 billion each way, is China, number one by far, which is why they hold the currency card ultimately, but that's a whole nother podcast. We look at their numbers, which just came out on Friday. Hello, we get inflation and trade numbers, over the course of the week. Exports, 5 months in a row, down on a year-over-year basis, down 10 out of 12 months. When we break it down by trading partner, oh boy, does it not even get more interesting. To the U.S., exports to the U.S. down 9%. To the EU, down 12%. To Australia, down 18%, one of their biggest trading partners. There's one place where they're increasing exports by a lot. Exports to Russia, up 21.0% for the year over year for the month of September. Now, other times when we've seen this kind of run of negative year-over-year numbers in Chinese exports have been only 4. Count them on one hand. Tech bubble crash, 2008-2009 global crisis, the pandemic, and one that may not be common knowledge to a lot of people out there, but the 2015-16 capital outflow crisis in China, which crimped their exports in a similar vein as to what we see now. So when we get to final demand, well, the real crux of final demand, of course, in China is resources and commodities. And they're the largest importer of all these things, pretty much. All right. Imports now down 7 consecutive months, down 11 of the last 12 months. How do you spell recession? In China, you spell it imports down 7 months in a row, and 11 of the last 12 months. So I know that China works their purchases of resources, commodities, and raw materials. They're very adept at doing this. They're very astute traders. I remember in 1984, when I started on a Florida commodities exchange in the gold and silver pits, I was on the point, which meant I was the conduit to all of the orders going into either pit. And I remember the phone, that was the Chinese phone. And man, when the Chinese phone rang, you jumped, the other clerks jumped to get it because it was among the most important phones out there. The Middle East phone, the phone we had that went directly to the kingdom's, quote unquote, traders Saudi Aramco and, the kingdom of Saudi Arabia, the House of Saud. I mean, that was, primary phone. And of course, the Chinese phone, they were still up and comers, but it was an important account and they could do big size. And they were very good at picking their points. They still are. They do it. I watch it all the time. And it is very telling in the sectors. For example, in this most recent decline, import decline, what do we see? What are the resources that are down? Copper, soybeans, rubber, and steel. When you look at the markets, what are the ones that are down? Copper, soybeans, rubber, and steel. It is not coincidence. My most recent experience with how good the Chinese can be as traders and how really astute they are at this was in the 2015-16 period. It was always capital outflow and the whole nine yards was going on in China. But besides that was also gold had gone through the Washington Accord in 1999 where central banks said we're not going to sell gold anymore, exploded, and it went to the 2011 high, and then it came off. And it came off into a very key technical level in late 2015, early 2016. And I remember this specifically watching this day after day after day when you would get gold below 1050. It was actually 1046, 1048 an ounce, precise price. That was the 50% retracing the entire bull move, going all the way back to the 70s in gold, to the 2011 high. And anytime you went below these levels, I'm not exaggerating, go back at the charts and look, you can check this out. There's upside tail reversals from below that level repeatedly, day after day, week after week, anytime you got below there, and went on for weeks. And of course, later on, you come to find out, oh my gosh, China was a major buyer of gold in that period. All right, they really play and work their imports extremely well. There are tells to be had here. Trust me on this. So what's higher right now in the imports into China? It's all energy. Crude oil, record highs up 14% year over year. Coal up 28%. And refined oil products, which is no chump change, it's a decent sized number, up 85% versus last year at this time. I mean, the first thing that comes to my mind, I don't know about you, is this sounds like a country that knows something. I mean, this is last month's imports, all energy related. And all of a sudden, you have this situation where, guess what? Well, Xi visits Saudi Arabia. Xi entertains the Iranian president in China. Xi calls for an end to sanctions against Iran. Shiite, both being juggled by Saudi Arabia, by China, and played very well on both sides. Syria, Lebanon, Russia, China, Iran, all together, bringing all of Israel's enemies together too. I mean, let's not forget, it was in much less than a year after the Olympics, after Putin had spent many, many days in Beijing with Xi, hammering out a 30 trillion renminbi oil deal that included funding in renminbi, state bank loans in renminbi to Russian companies that would build out a new pipeline in Siberia and would build out the infrastructure, including in this deal, Kazakhstan, that would then ship natural gas. So for oil and natural gas to be shipped out of Russia, the 30 trillion renminbi deal, including state bank loans from China in renminbi. And what happens when the Chinese Communist Party, their plenary session, they come out, what is the number one item on their top things for the next 5 years, which is what they always do, been doing this for decades, all right? Number one, food security. And what do you know happens next? Russia invades Ukraine for food and ports to ship it to China. I mean, did we not start to see the connections here? I mean, we have talked about Xi. The guy's brilliant. I mean, to whatever extent, from his perspective, he is brilliant. U.S. educated, all right? Mao is his theme, man. I mean, he is a Maoist at heart. His dad, number two man in the Mao regime. You know the whole story, right? If you don't, you ought to check it out. It's pretty amazing. In the sense that it's manifest destiny. Manifest destiny is the idea here. And to the extent that it used to be China would back off anytime U.S. lobbed criticism at them, especially for human rights and workers and wages and all this, to be like, oh, we'll try better and we promise. They don't say that anymore. Notice what she says. She says, look, you got kids killing kids in your schools. You do you, we'll do us. We think our system is better. Don't tell us how to live. And, frankly, for whatever extent, I'm not saying right or wrong in anything, but that's the way they're choosing to go, and they're damn good at it. Right? To the extent that, is this all now a cover where you just when you have inflation coming down too, the timing is impeccable. Just as inflation starts to come down, maybe you get a soft landing. I don't believe that, either one of those things, but you can't say that it's not possible. I don't know that I'm right here, and I'm not always right. But in the context of, if that were to be the case, and it would be the appearance of the case to the outside world, what a great time to unleash a surprise attack that was highly coordinated. And then to bring the other side in, being Hezbollah. Hello? Come on, man. I just feel like this has such a bigger picture feel to it. It's not even funny. And to whatever extent, this is kind of covered than even for something in the South China Sea. You have trouble with the Philippines. All right. We know the fishing dynamic. We have trouble with Vietnam and gas rights and oil rights. You have trouble with Taiwan right off the bat. And you have trouble with Malaysia. You're seeing the flyovers there too, invading the airspace. It's a South China Sea manifest destiny. And frankly, between China, Russia, and OPEC, it's basically that side of the world manifest destiny. They're not building a road. Once Afghanistan, we left Afghanistan, U.S. forces left Afghanistan. What's the first thing China did? Started their road, their great road. It's going to go through Pakistan, Afghanistan, through the Middle East, and right on down to Africa. And what is it? It's a transportation route for resources. Come on, man. The grand plan there is huge, and it's well thought out, and they're executing it beautifully as we sit here blind, worried about what's coming next in a political circus that's going to envelop all of us. And while we're sleeping in this stupidity of both sides of this argument in politics, right? I don't support either side, frankly, right now, because both sides are so divided and so into what they want. It's ridiculous. As opposed to we, the people, that's a whole nother story, okay? Let alone the hatred you have in the world that we should be unifying as Americans, but we're not, at a time when hatred is on the rise and this kind of violence is only going to, extrapolate, I think. So there's a lot going on here, just even from that perspective, before we even get into the geopolitics of it. But to me, the geopolitics of it are a much bigger picture that has to do with kind of the timing of how do we weaken the West if we're China, Russia, and OPEC. They've banded together. And, Israel and the U.S. are in the crosshairs. If you don't think that, you don't believe that, then you're kind of not seeing the bigger picture. And the extent to which, again, China is simply outplaying us in a kind of gross way. The question then becomes, to get back to kind of where we need to be here in the markets for now, while we, let all of this geopolitics play out in whatever way that's going to play out. We already think we know how that's going to affect the markets. We'll come to that at the end of the show here. But is inflation over? Can the Fed declare victory? Well, CPI is back to 3.7 from 3. I don't think 3.7 is anywhere near 2, and certainly doesn't, as Powell says, he wants to ensure inflation is defeated. At 3.7, inflation is nowhere near defeated, number one. Now, I would say it's not as problematic for the Fed because they still have a restrictive policy rate at 5.5 relative to 3.7 or relative to PCE or relative to even the smooth Atlanta numbers or the Cleveland, chain numbers, whatever number you want to look at for inflation. I like CPI, just straight up, because all the components. You can see it. I can feel it. I know what it is. I know the insides. I know what's going on in there. It's 180 basis point real Fed funds rate. That's tight. It's restrictive. The Fed is where they want to be right here. They don't need to move. All right. I call Godot, that Godot would show up. The famous play, Waiting for Godot. He never shows up. That's been inflation in the U.S. for the last 10 years until finally Godot decided to show up. And we wrote about it in 2021, early 2021. And boom, there it was. Godot showed up. Then you couldn't get him to leave. Then I said transitory was the worst word possible to be using. Of course it was. And we said you see a peak that would kind of have an 80s feel to it and would disinflate just as it has based on the energy base effect. Because the only thing that's negative right now is energy. The only thing that is negative is energy and some food items like, lean hogs had gone down. So there was a period of time where meat was negative year over year. But really, the only thing is energy. And now energy is going to go up year over year. And we'll talk about that in a second. So now we have the potential for the reverse base effect. I also told my clients in my July 21st Weldon Live, goes to institutional and wealthy individual investors, at 74.59 crude oil last change, I said, we're going to 107 to 114 at some point in the fourth quarter. You have a 2.5 million barrel per day deficit. You've already drained the strategic petroleum reserve by 40%. Joe Biden has just let it all go. And you have a situation now where you're going to draw down inventories to significantly low levels. And bam, you have a war breaks out in the Middle East. So what if inflation doesn't stay at 3.7 or below 4? What if inflation jumps to 5.5? Let's just say, what if inflation jumps to 5.5? Then what? It vaporizes your restrictive policy in one fell swoop. The Fed doesn't have to do anything to have their entire restrictive policy thrown out the window. They would be neutral, because 5.5 inflation against a 5.5 policy rate is, guess what? Probably not even neutral. It might even be a little stimulative. R-Star and 311 pages of white papers published in 2018 tell us R-Star puts the neutral rate at 50 basis points above the rate of inflation. Doesn't say what inflation rate. They talk about that all day long. But that's a whole nother point. To keep policy restrictive as it is now, they have to go to 7%, which is where this whole thing around 7% came from. Didn't come out in thin air. Didn't just pick 7% as a nice number that we can scare the public with. That's a real number, because inflation could go to 5.5 on the base effect of energy. And if energy goes higher from here, you're almost certain to get to 5. Now, within that context, one of the things I had said way back in our podcast here was that the Fed and Powell's comments were very specific to this. Did not like the fact that the forward Fed funds market back in April and May of this year was pricing in 200 basis points of rate cuts for next year, and at the first half of next year. And I said, the Fed will be on hold, or will continue to push, and will certainly continue to push, most importantly with the hawkish rhetoric, the things that they say. And we see that all the time now. You really do. Until that was eradicated, you eliminated that easing priced into the forward Fed funds market. And guess what? They did. And it really came about in September, especially when Powell really talked tough. I mean, that was the last gasp, and you pushed all of that easing is gone. You have some now at the end of next year, 50 basis points of easing priced in the end of this year. But this kind of gets you to the idea that, hey, wait a minute. Okay, no one now expects the Fed to move at all, which means we have 15 months of restrictive policy coming. All right. So, yeah, the economy hasn't completely folded yet. Do we think we can stand 15 months of this? All right. Number one. Number two, I could argue, and I will, that policy has not even been restrictive that long. Because as rates came up, inflation was coming down, but it was still a negative policy rate for a long time until like May. All right. You could say it's 5 months. I'll be conservative and say it's 7 months. It doesn't matter. 5 or 7 months is it for how long the Fed's policy rate has been in a restrictive position. And if we're talking lags of 12 to 18 months, we are still a long way away from feeling the worst of this. Now, there are factors that offset that comment. There really are. Banking system had its poorest part. Will it have a more poor situation, or worse situation show up? Well, we know delinquency rates are rising. We know the consumer stress. Yes, maybe. All right. So this is kind of what's interesting too. And if energy is going to spike here, it's a dagger in the economy, and it's a dagger in the stock market too. Because if the Fed has to, continue to push a restrictive narrative, or actually move rates even more, stock market will crack wide open. So where is inflation right now? Because we just got the numbers 2 days ago here in the U.S. All right, data scalpel, please. Dissection in process. I start with the fact that over the last 2 months, the monthly increases in the last 2 months are the largest back-to-back monthly increases of the year. It's 1%, which is a 6% annualized number over the last 2 months. The cities. There's 24 cities that report, I believe it's 24. They split them. There's half one month and half the next month. So every other month you get half of the cities. This month, 9 of the 12 cities reported 0.9 or higher for the month. That's a double-digit rate of inflation year over year in 9 of 12 U.S. cities that just reported the places where most people live. Inflation was high here in August, September. Let's look at some of the cities. Dallas, 1.0. That's 12% annualized. Think about Minnesota, 18% annualized at 1.5% for the month. San Diego, 1.3. Tampa, 1.1. New York City, 1.0. Washington, D.C., 1.3. Huge monthly numbers. Third, I will note, services, ex-energy. Services, 5.7. Is it down from its high? It is. But guess what? It's still 5.7. It's almost 3 times the Fed's goal, target rate. And it's services. All right. And when you start talking about services, rent, a big part of services, of course, 7.2%. All right. Is that down from its peak? A little bit, but it's 7.2% for the largest monthly expense. Has one of the highest inflation rates still. And this is sticky because guess what? You don't change the amount of rent you pay every month. You change it once a year, maybe once every 2 years. And guess what? Likely it's going to go up next year anyway. So this is sticky inflation that has a big impact on the amount of money people have to spend on discretionary items. Case closed. This is big. I'll throw another one at you. Garbage and trash collection up 6.9% still. 7%. And when you look at the index, I like to look at the index itself sometimes. And then go back to 1971 when the Nixon closed the gold window, took the dollar off the gold standard. When you look at the lodging index, okay, and lodging doesn't mean, hotels and stuff. It means rent, hotels, and all of this. You're talking about a clear upside acceleration in the last 18 months, going all the way back to 1971. It's a pretty smooth, angle. The line of the index going back decades until now. Now it's like almost gone parabolic, straight up and down. Same with something like food. Food, we normally focus on food at home, but food away from home is still 6%. Still 6%. So when you look at these kinds of things and you think to yourself, guess what? Energy is going to kick in with a base effect here. Let's talk about that because, crude oil right now, I'm actually going to look at the board as I'm speaking here on a Saturday morning. Crude oil went out, the December crude went out, WTI at 86.64. You seeing that right? Yeah. 86.64. So right now it's the same as October a year ago, 86.81 October a year ago. But November last year we went to 80.50. December we went to $70 last year. Do you see? By staying here, by December, you have a $15 year-over-year increase in crude oil prices. Natural gas is even more pronounced, all right? Natural gas right now, as we go out, the December contract's $3.61. It's risen. I kind of like it here, too. Last December, it was $7.20, but by the beginning of December. By the end of December, it was $4.43. By January, it was $2.70, and by February, it was $1.96. So again, energy from natural gas and crude oil alone, gasoline's gasoline's come off a little bit, so it's less of an impact there. But every move higher in gasoline from here does add to inflation because the base is zero. Energy is to the upside here from now on in terms of, where it's likely to go based on the mathematics. Even if it just stays where it is. If it rises, holy mackerel, the year-over-year dynamic will kick in and you will be at a 5 handle of inflation real fast. And the Fed's policy will be neutral. And then what? Then they have to go again? That would really bring the economy down. But frankly, isn't part of this, they want the economy to come down? They've said this, pain. I have been saying now for a couple of months here, really since middle of late August, that the Fed, especially after September and Powell's comments, the Fed wants disinflation in the market. All right. And if you look at what the dollar is, it's kind of, dollar higher here is bearish for stocks. It's bearish for commodities. If the Fed, if Powell wants to do what he says he wants to do, which is to ensure that inflation is defeated, use the dollar, and that's where the hawkish rhetoric continues. They don't necessarily have to hike rates again unless inflation does rise again. Okay, so in the meantime, to stimulate the hawkish monetary conditions dynamic, which is clearly we see because the dollar has gone up relative to gold in a big way here. All right, even with the rally in gold, which I like, but still, dollar higher means economy disinflation, commodities, food, and energy. With all things, other things being equal, disinflation, and the stock market disinflation. Because if you've seen the charts that I've offered you, you see how correlated it is. The dollar down is good for stocks. The dollar up is not good for stocks. Case closed. Case closed. And to disinflate all of this would ensure that they could declare victory on inflation. Not that I think they ever can. I don't think they can. I think they're going to be forced out of this sooner rather than later. I think you're going to have some real problems with energy. It's going to cause the stock market to sway, and that's going to kind of soften their tone. And they're going to acquiesce to a higher level of inflation and a lower standard of living and a kind of a lower general economic growth dynamic. And this is bad given all the debt. It really is. It's a problem. But having said that, what do we do portfolio wise as we close it out today? We'll spend the last few minutes on what to do. Right? Well, right now we're split in our, standard kind of stock portfolio. I wouldn't say standard, our top select portfolio would be about half energy, half infotech. Yeah, I still like infotech. We'll talk about that in a second. But in terms of energy, you also have to have some other things in here. So long dollar, you can use the ETFs. We have the portfolio playbook we do now that's actually linked to the podcast with the same name. So you can check that out and get a free copy if you want to email me at sales@weldononline.com. But it's also being long the dollar here. It's also having some length, some exposure to the short end of the U.S. curve. And just in case you do get some kind of, real problem that erupts all of a sudden, and you will see a rally in bonds, and we want to take advantage of that in the short end because the short end, I think, is, overcooked relative to the long end. And then even potentially having like the SH or the SQQQ as some short stock index exposure. I'll talk about that in a second. I also don't mind owning one of, if not all, at certain times going forward. Right now, I own silver, owning silver, gold, and Bitcoin. A lot of more people can buy Bitcoin. They can run to a bullion dealer and buy gold in a case where the currency is getting wasted or something geopolitically is happening. So I still do like Bitcoin for that reason. In terms of energy, yeah, the XLE is the thing. If you take out 84.25 though on the downside in the XLE, I'm not so sure I want to like it anymore because everything could go down here if you get some kind of event, so to speak. And I think the odds of an event are increasing by the hour. All right. But more so the commodities. USO is the crude oil ETF. UGA is the gasoline ETF. And I really have liked, and we've talked about this, uranium. URA is the uranium ETF. I like all of those. In terms of the tech, the high tech, the infotech, the high flying tech, I should say. That's what I meant to say. The XLK. If the XLK, which is the information technology S&P ETF, gets below 160, I don't like it anymore. I'm also taking tells from NVIDIA. Why? Because it has this huge gap. And it had a huge move down to like 406, and it had another big rally, and it came down, and I thought it was going to break and try and fill the gap, which is all the way down to like 380 or 360, is 409 in NVIDIA. You get below 409 in NVIDIA, I think that's worthy of note. And, I kind of do think that the SQQQ, the short, bear index, which is the leveraged one, be careful. This is not for everyone. Really need to watch yourself on this. It's a highly risky dynamic to play this. Having said that, aggressive traders with risk capital only that can afford to lose some money if we're wrong. Above 1473 is kind of a breakout in the SQQQ, and that will go hand in hand if you had a move in the NASDAQ below 14,600. It's a massive double bottom at 14,600 in the cash NASDAQ. You have now created with the most recent high you set this week, which was on a downside reversal day, by the way, 4 lower highs. That's a really reliable pattern. If you break the lower end, you're gone. All right. Not only that, at the lower end is right in the middle between the 100 and 200-day exponential moving averages. And beyond that, my proprietary oscillator algorithms I wrote in the 80s and still use today are at new lows in both the S&P and the NASDAQ. And what that typically means is those lows in price are going to be taken out. That is 14,600 in the NASDAQ I think it's coming. I just did a piece that shows that chart specifically in a macro market minute. It is 1 minute videos that I post on YouTube for free. All right. User / Gregory Weldon, capital G, capital W, one word, Gregory Weldon. Check out my YouTube channel. Also, follow us on Twitter. You can follow me on Weldon Live on Twitter, at Weldon Live. Or follow the podcast, man. We post some cool stuff on there, at Money_podcast. Greg Weldon here. Thanks for listening. Until next time.